Well, hello, everyone. Thomas Montgomery, IIMFL, the Institute for Improved Minority Financial Literacy, and it's great to visit with you again. We're going to be talking today about building credit for small business. This training is an important step towards building a better business. As you'll see over the next few minutes, this module summarizes the importance of having both a good personal and business credit history for small business owners. As lenders use different approaches to assess creditworthiness, including personal and business credit histories. This training has 5 sections that we'll go through. It's one of our little bit longer lessons, modules, but I think you'll enjoy it. So just step back and let's realize that this is the second of the 4 modules that we go through in the small business certification. The first module you should have already completed, and that was on planning. And then our action step for that was to actually begin your business plan and financial projections. Because our pattern is we teach a lesson and then we implement. So this week we're going to go through building credit, talking both about personal and business, and then we'll have some action steps afterwards. It's important to remember that this curriculum was developed by the FDIC, it's promoted by the SBA, and we have received exclusive grant funding to administer the small business certification with the goals of improving financial literacy and access to capital. And as I mentioned, this isn't one of those where you just sit back and listen. We're going to learn a lesson and then we're going to implement it with you in your business. So we can see change, so we can see results, so we can position your business to have access to capital. There are a couple important resources that you're aware of. Obviously, the YouTube recording that you're listening to now is one of those. The second is a participant's guide. If you've not received your participant's guide, I'd recommend that you pause this recording and request that, because the participant guide is an important tool as you go through each of the modules, this being the second module. Now, after this lesson, you're going to actually be assigned one of our financial literacy educators who's going to confirm understanding and then have some action steps with you. One of the primary action steps, and there's a couple, but one of the primary action steps from this lesson is helping you develop a personal financial statement. While a personal financial statement isn't specifically regarding credit, it is an important bridge to our third topic on financial management. So your financial literacy educator should be in contact with you here soon, if not already, and it's going to help you develop your personal financial statement as a bridge to Module 3. So be sure to prioritize working with him or her so you can get that done. We'll also be helping you look at your personal and business credit after this lesson. So the agenda for the curriculum today includes the welcome, which we've kind of accomplished, a pre-survey and learning objectives. The section 1 is on the big picture, credit reporting in your business. Section 2, we're going to talk about personal credit and how that impacts your business. I can tell you I've been involved in the business credit space for several years, and there's quite the interest in accessing capital and building your business credit under the EIN versus using your personal credit. But we're going to dive in today, understand both, see how they interface, and make sure we're all on the same page. So personal credit does play an important role. That's section 2. Section 3, we'll dig into business credit, Dun & Bradstreet, and so forth. Section 4, we'll go ahead and take a look at how lenders evaluate your credit worthiness. And I think that's really important because it's so easy, since we see through our eyes and walk in our shoes, we tend to think about it from our perspective. But one of the primary benefits of having strong credit is that from the lender, the underwriter, the bank, the credit union, what have you, you look stronger. You've demonstrated you're responsible behavior of managing credit. So part of our exercise today is not just to look at everything from our view, but to understand it, as we're talking about on section 4, how lenders see you, because that's really what matters. If our goal is to increase our credit worthiness, to increase access to capital, it's about what they think, frankly, more important than what I think or what you think. And then section 5 is on credit reporting and business operations. So this is one of our longer lessons. It's an important one. You can pause it whenever you want, but we need to proceed forward. And then we have the summary. With that being said, you'll see on the summary, so we have the normal pre and post survey that's in your participant guide. We have an evaluation, which we'd love you to fill out. But we'll have a couple action steps after this lesson that your financial literacy educator will work with you on, and you'll also have instructions to be able to get started on these even on your own. And that is to do a soft credit pull. Doesn't impact your credit score, doesn't commit you to anything, but it allows us to fully evaluate your credit profile. And we'll look, as we go through the 4-week course, we'll look both at your personal and business credit profiles to give you feedback, and the PFS that I mentioned a moment ago. Do you remember what the PFS was? Personal financial statement. Okay, so with that, we're going to understand how the personal and business credit reporting landscape relates to your business as one of our learning objectives. We're going to identify what goes into personal and business credit reports and scores. We're going to learn how to establish and build strong personal and business credit histories. We're going to understand how lenders and others may use your personal and business credit information. Furthermore, we're going to learn how credit reporting services may benefit your business. We're going to leverage strong personal and business credit histories for better financing terms. A stronger credit not only increases our probability of approval, it also can often give us better terms, better financing terms, cost us less money for borrowed funds. We're going to recognize when business credit history may become a bigger factor. And I really like that part, because so often small businesses will come to us and they might have a pre-launch or a startup business, and they're saying, no, I just want to use business credit only. Well, you will learn that there's some sources of capital, absolutely, that we can use business credit only on, without the use of personal credit, without personal guarantees. But that's not true for all types of capital. So we're going to dispel some myths and some misunderstandings, so you're more empowered to know how each type of credit may play a role in your access of capital. Now, we love to teach this in person, and so if you're part of a chamber, a church, an organization, it would be our pleasure to come out and teach this in person to your group. When we do that, we teach it usually in one day, so all 4 modules will be completed in one day instead of a module a week like we're doing now. So on this one here, we don't have quite the ability to get your feedback, do we, on a recorded YouTube, but it is important to reflect on what is it that you currently know about credit, whether it be personal or business, and then think about what it is that you want to learn today. So maybe just take a moment and write down 2 or 3 things that you want to learn from today's lesson, and then we'll move forward. All right. In our participant guide, again, you'll find a number of the documents that you'll use, like the surveys and this form here. With all that being said, let's dig right in. Let's dig right in, and we're going to talk about the big picture, credit reporting, and your business. So with that being said, why are credit reporting agencies important to your business? Well, if we're going to seek financing, then how credit reporting agencies view me and or my company is important, because really no one knows the future. No one knows the truth. Will I pay my bills in the future? Will I not? No one really knows. But obviously, again, if you and I were sitting on the other side of the table together and evaluating, do we want to offer loans or lines of credit or other financing instruments? We need to have some process to determine, does this make sense for us as a bank, for example, to loan money to someone? And looking at how they've managed their credit in the past is probably one of the key indicators, right? Because again, no one knows what the future is like, but the past, especially the recent past, can be one of the strongest predictors. Credit reporting agencies are important also from managing debt and obligations. And so they're looking at how much debt you and or your business currently has and how you've managed it, and to assess risk. So to me, these three bullets are very interrelated and overlapping. But I think the bottom line that I'd like you to take away from this slide is that we need to pause and think about what the lender or the bank or the extender of credit it needs to do to make sure that they feel that it's a reasonable and practical approval decision. And looking at how we've managed our finances is probably a very important part of that, wouldn't you think? Now, it is interesting. It is absolutely true that there are some sources of capital that do not care about credit worthiness at all, that won't look at your personal credit, will not look at business credit. That is a true statement. But in general, credit matters. So let's define credit. Credit is the ability to borrow money or goods based upon the promise that it'll be paid back, and it's important for the financial stability and success of individuals and businesses. So during this lesson, we're not really talking about types of loans or types of capital. We're going to get into that in the fourth module of the small business certification called Banking and Money. Today, we're talking about credit itself. Now, there is a difference between personal and business credit history, and actually there's several differences, but at the highest level, personal, as shown on the left-hand side here, is your use of credit as reported to consumer credit agencies. In contrast, on the right-hand side, business credit is your business's record of handling debts and financial obligations. Technically, to establish and build business credit, which we'll talk more about here in a few minutes, we need to have a business entity. So usually we would not build business credit off of a sole proprietorship, a DBA, or a partnership. Normally, to build business credit, we would need an LLC, a C Corp, or an S Corp, are the main three categories. So keep in mind, normally we will not build business credit off of a DBA, a sole proprietorship, or partnership. We need a more formal structure. And then we would need the EIN number. With that being said, and now the EIN number creates an entity, a business entity, like your social security number is a unique identifier for you as an individual. So individually, you can build credit off of your social security number. And then once your business is properly set up, which we'll talk in a fair amount of detail and help you with after this lesson, businesses can build business credit worthiness off of their EIN that reports to a separate set of agencies. So I wish we had a line right down the middle of this slide, because not only is it two columns, they really are very different in how they act and how they report. This is a schematic that talks about different uses of credit and whether it be accessing financing, getting working capital, buying equipment, getting inventory. It's important because there's very few business models that are going to be so self-sustaining, that are going to generate so much excess cash flow that they wouldn't need or benefit from third-party financing. And that could come from, I'll give you an example. One of the things that will help you do is build out your business credit profile. And one of the business credit cards that we often include in that is Home Depot. And I have one here in my wallet. So I have a Home Depot card that is under my tax ID number. It's under my EIN. It's under my business. My personal credit didn't go into the approval. If I don't pay it, it won't affect my personal credit, doesn't reflect on my personal credit report. Well, depending upon the industry you're in, you can imagine, let's say that you're a tradesperson, so you're either building homes or remodeling homes or even in real estate fix and flip. It's not unusual that you might need to go buy a new shower head or a whole new shower or a new sink or what have you, new appliances. And so if you have to pay all of that out of your operating funds, that can maybe stretch you a little bit because there might be some lag time from when you have the expenditures before you can, let's say, fix and flip that real estate. Well, if you have credit from Home Depot, like we're going to help you establish, now all of a sudden you can make those purchases, but you don't have to pay it right away. So it helps with cash flow. So ultimately, the importance of credit for a business is to support business growth and sustainability. This is a pretty important graph. Let's understand it. So it's defined as the personal and business credit spectrum. So on the y-axis, which is the up and down arrow, talks about the importance of personal credit. And on the x-axis, the left and right, the arrow that's going from the left to the right, is the importance of business credit. When we start a business, if we're early stage, and this is not true in every case, but in most cases, let's talk about business loans, whether it be just through your local bank or an SBA guaranteed loan. Most business loans are going to look at the personal credit worthiness of the borrower. And you might say, well, why is that? This is a business loan. This is for my business. This should be under the EIN. Well, unless the business has really established itself, which is shown in the kind of the bottom green box where it says only very large and sophisticated businesses may not need to rely on business owners' personal credit history. In most cases for early stage and startup businesses, we're not going to be able to go apply for a loan without them considering our personal credit worthiness. And it makes sense. That may not feel good to you right now, but that makes sense, right? Because the business isn't strong enough yet on its own, and they know that you're controlling the purse strings. And so if you've paid your bills in the past, that gives them optimism that you'll probably pay your bills going forward, including those that you're responsible under your business. But if you've not been able to pay your bills in a timely fashion, that gives them caution. I will tell you, though, that there are certainly some sources of capital that we can pursue that do not use personal credit. But from a loan perspective, we've done a lot. I came from the SBA, you know that, I think. So talking about the SBA loans, one of our most popular SBA loans is a 7A Express. It's a working capital loan up to $150,000, processed very quickly. It's available to startups. And the SBA technically uses a different type of credit scoring algorithm. And we're talking about credit scores, both personal and business. But the SBA, for example, uses FICO, which you've probably heard of, SBSS. And that may confuse you, but the bottom line is it incorporates elements both of personal and business credit. And you're not going to go get an SBA loan without them pulling your personal credit and without a personal guarantee. So what are we trying to accomplish on this slide? There are certainly, like the Home Depot card I gave you an example of, there are certainly types of capital that we can get only using business credit. But I don't want you to be misled. And so often we will hear from small business owners that think, I'm going to go get a business loan and only use business credit. Because if your business hasn't been around long enough, doesn't have a strong enough track record, doesn't have enough revenue, doesn't have enough assets, then it's unlikely that an early stage business will get a traditional loan under the EIN alone. All right, moving forward, credit in your business. And so you might think, have you applied for business loans or lines of credit in the past? You know, do you know the difference between a loan and a line of credit? A loan is a specific amount, let's say the $150,000 SBA loan, So they wire that into your account when you're approved, and you have that to use, but you owe interest on the $150,000 because that loan is funded. In contrast, a line of credit is a pre-approved amount that you can pull from as you need, and then as you pull from it, then you pay interest off of only what you've used. There are some hybrid lines of credit that we've done, and some of those can apply to early stage businesses and be under the EIN. But that's the difference between a loan and a line of credit. You might think back, what did they ask you for? Now, part of our goal of this grant subsidized 4-week small business certification curriculum is we're actually helping you, and it may not always see, you may not be aware that that's what we're doing, but we're helping you build your loan package. The loan package is the typical set of documents and resources and preparation that you would need to be able to get funding, to get approval. But you may think back what they've asked you for. They might have asked you for a personal financial statement. You might not have had help or experience in creating one before, like we're going to help you now, and that could have impacted your approval. In many cases, you don't get real good feedback of why you don't get approved. Lenders have to follow certain regulations and requirements and non-discrimination elements, and so while there often will be a stated reason, it's my experience that in some cases it's a bit more complicated, and we're going to talk about the 5 C's later in today's lesson that talks about the broader picture of often what's included in loan approval. Okay, moving forward. So I understand, and I've acknowledged already, that many of us wish that for our business and business funding that personal credit played no role in it. Wouldn't it be better if that were the case? If we have great credit, then our great credit wouldn't be at risk. And if we don't have such great credit, then our personal credit history wouldn't be an impediment to getting business funding. But we've already established that in many cases, especially for early stage and startup, for traditional loans, your personal credit will matter. Now, the good news is we have some resources to help you boost personal credit quickly. We certainly are not a credit repair company, but we actually have a lesson on credit repair, and we have some techniques and resources that can help you. Credit is fluid, and that's important to realize, whether we're talking about personal credit like right now or business credit, as we'll dig into here in a few minutes. Credit is fluid and it changes. So we're not going to worry much about less than perfect credit, because we can alter it legally and ethically and improve it so we can often qualify. But let's talk about the impact of personal credit on your business. Well, it tells lenders the following: who you are, and again, we're talking about personal credit right now. We're talking about business credit, but right now we're talking about personal credit. So personal credit states who you are, how much debt you have and how long you've had it, how frequently you're applying for credit, how much of your credit that you're using, if you're making payments on time or if you're late, and any negative information that may be out there, including public records such as bankruptcies and foreclosures. There are 3 primary consumer credit reporting agencies. In truth, there's many, many others, but 3 primary: Equifax, Experian, and TransUnion. When we get over to business credit, there's a different set of reporting agencies that behave differently, but we'll get to that in a minute. On personal credit report information, you can see here on this graph, there's 4 columns. There's personal identifying information, like your name, your social security number, current and previous addresses, date of birth, and so on. There's your credit history. There are your inquiries, and then public record information. We're going to help you after this lesson pull with a soft pull, so it won't be an inquiry, it won't affect your credit scores, but we'll help you pull your credit report and review that. And then if there's anything that needs to be done, we can assist you in improving it, because again, credit is fluid. But this shows what's on your credit report. I think it's more valuable to look at your credit report, and we'll do that after this lesson. What does not appear, and this is interesting because sometimes people wrongly perceive what is included in their personal credit report, and it's often not. So checking and a savings account balances, how much cash you have available, is not there. And you might say, well, why is that anyone's business? Well, if you're wanting to borrow money, your liquidity is important, because the amount of liquidity you have, the more liquidity you have, the more confidence that the lender or the extender of credit will have that you're able to pay them back, especially if you hit a bump in the road. But this is not included. So when they pull your credit report, they will not see how much cash you have. They won't see your income, although it's not unusual as part of a credit pull that you will provide your self-reported income. And this is a big deal, because especially if you have a little bit stronger credit, they may not even ask. For instance, let's say you're going to buy a car for yourself. If you don't have such good credit, chances are they're going to say, well, we need to see your last couple paycheck stubs. But if you have really good credit, they will not, typically they will not even ask for your paycheck stubs. But your income is often asked on credit applications, and that may be stored in a database. And so we need to be consistent with what we report our income is, but we'll leave that for a different discussion. It won't tell anything about your medical history. It won't tell or show any purchases that you've made with cash or checks or debit cards, of course, because that didn't really go through the credit system. It's not going to say anything about your business account information, although it'll typically report your employer. It's not going to give the reviewer of your credit report any information about your race, gender, religion, anything about your driving record, and typically not your marital status. And so what we've just covered in 2 quick slides is what is included and what's not included. Again, we'll review yours with you as part of this curriculum. So credit scores are important, of course, and that is a number that helps lenders determine your credit risk. I will tell you, though, that many people wrongfully simplify this and just think it's all about my credit score. Because I've seen people that have good credit scores that have very limited access to capital because of the construct of their credit profile. And then conversely, I've seen people that didn't have that strong of a score have really good access to capital because of the construct or what was on their credit profile. So credit score is important, yes. They change often. You have many different credit scores. You're going to have different credit scores from each of the 3 bureaus. And then there's different credit score models, including FICO and Vantage. Also, other lenders have their own credit scores. And I told you a few minutes ago that the SBA uses a specific scoring algorithm called FICO SBSS. So to make things more even confusing, you don't have one FICO score, nor do you have just one FICO score for each of the 3 bureaus, Experian, Equifax, and TransUnion. There are different scoring algorithms like the SBSS that I made reference to before. So in truth, you have many, many, many different credit scores based upon the algorithms that's being used. And that's important because sometimes people will say, well, I just checked my credit and they'll say it was a 686 and now you're telling me it's a 640. That can't be right. Well, it could very well be right because there's a different score model being used by you and the other person, and there can be variances. So this gives us a quick overview, both of FICO and Vantage score. What is similar that both of them range from 300 to 850, but their scoring factors have some variability. You don't really need to know the details, but what is most important in both cases is your past payment history. And that makes sense, doesn't it? If you've not paid your bills in the past, especially the recent past, then that doesn't give the lender or extender of credit much confidence that you'll pay it on time going forward. And then secondly, FICO's second biggest category is your outstanding debt, especially your revolving utilization. So we want to maintain a low revolving utilization, and we'll talk more about that during today's lesson, as well as in your individual credit review. But we need to actively seek to manage our credit, both our personal credit and our business credit. So you might ask, well, what is a good personal credit score? And frankly, part of it depends upon how you're using it. You can go buy a house with a federally backed mortgage with a relatively low credit score. But if you ever wonder why, in addition to the guarantee, so that the actual bank doesn't have that much exposure, another reason is it's collateralized. So if we were to go borrow $150,000 to buy a home, that home is put up as collateral. There's a lien against the home, on the mortgage. And if we don't pay for the mortgage, make our mortgage payments after a certain amount of time, we're going to go through a foreclosure process, and they're going to take the home as collateral. Well, no one wants that. But in contrast, let's say that we're just getting a $150,000 SBA working capital loan for your business, which is relatively attainable for most people. Well, in most cases, there's not a lot of collateral pledged. And so once you have that money and you spend it, they can't come take the keys to your house in that example. So the bottom line is, depending upon what type of capital we're pursuing will determine what level of credit score we need. Before the pandemic, we were doing a fair number of business loans with much lower scores than you would have thought. Now the credit market is a bit tighter, but as we get through the pandemic and our economy gets back to a steady state, the credit will relax some. But in general, strong credit would be considered prime credit. If we have a 720 or above FICO score, that's usually going to give us the best approvals and often instant approvals. But I don't want you to worry if your credit's not so ideal right now, because again, credit is fluid. It can change very, very quickly. In general, credit doesn't have a memory, so we can do some things together to get those scores up. It's not unusual for us to help a client raise their credit scores by 50 or 100 points in just the first 30 days. So keeping up with your personal credit report, you can get a free personal credit report once a year, every 12 months, from each of the three main bureaus, which were Equifax, Experian, and TransUnion, and you would go to annualcreditreport.com. Interestingly, the free reports don't give you the scores. It gives you the line items, but not the scores, which is commonly what we all track, how strong our credit is. But we'll help you do a soft pull and get you your scores. So we want to be getting your reports on a regular basis and reviewing them, because negative information on your credit report might be yours because life happens, or it might be inaccuracies, right? And there's a whole different set of strategies and techniques of how to address derogatory items if they're really yours versus if it's an error, an omission, or an inaccuracy. So that's why we need to review the credit reports and then create a plan to address the derogatory items. Now, after a while, the derogatory items will fall off, but that could be a long, painful ride. So in most cases, what we'll want to do is be checking our credit reports on a regular basis and seeking to add positive and remove negative. That's how we get a high credit score. Many people won't tell you that, but the truth is, to have a really high credit score, it's both adding positive credit and removing negative. You could have someone that's gone through some tough life circumstances, and if you had a magic wand to get rid of all the negative items, that in itself wouldn't increase the score. We need to have positive credit reporting in the absence of negative, the absence of derogatory. So when we go to remove derogatory items, there's a number of different strategies, and we've seen some models that are gray and we wouldn't condone. But if we're just talking about what's provided for us through federal laws, which we'll talk about on the next slide, we can dispute derogatory information because everything that's on our credit report must be accurate, complete, and verifiable. I'd like you to write that down. Accurate, complete, and verifiable. So anything that's on your credit report that's not all three, that's not accurate, not complete, and not verifiable, can be contested to be removed. And so a dispute is one way to do that. There are different ways to do disputes, and often we see ineffective ways. And so while dispute is a specific verb, and maybe it's a common practice within credit improvement, how we dispute makes a tremendous difference in the effectiveness. And we'll teach you how to, if needed in your credit profile, how to effectively dispute versus ineffectively dispute. All right, so we talked just a moment ago that there are some federal laws that protect you, including the FCRA and the FACTA, and these define regulations for personal credit bureau reporting, including the purposes for which lenders and other businesses can obtain your personal credit report, when you need to give permission, and your rights to see your credit report, as well as how to go about disputing items that you believe are incorrect. We're not going to spend as much time on these slides, but they're here for your reference, and they're in your participant guide, because we want to spend time on your credit report and learning about your credit profile, because I think that's more important than a general or an example one. So what are some best practices for building a strong personal credit history? When to maintain healthy credit, pay your bills on time. Sometimes life doesn't allow for that, and we understand, but if at all possible. Secondly, we want to keep outstanding revolving debt balances low. And so what that means is like credit cards, where you could use a little bit of it or a lot of it. And so let's say you have a credit card with $1,000 credit limit. Using your credit card is not a problem. You need to be conscious and aware of the reporting date. So let's say that I'll use my Discover card. I'll give you a real life example. So my Discover card, I have a $19,500 credit limit, and it reports on the 1st of the month. So I could use as much of my credit limit as I want during the course of the month. But come the 1st, I should have that paid as low as possible, because that's what goes to the bureaus. So if I'm using $0 on the 1st, then all 3 bureaus that following month will report $0 utilization on my Discover card. I could go out and spend $10,000 on the 2nd. The world wouldn't know it until the following 1st of the month, when it takes another snapshot. So I'm not saying try to game the system, but I'm trying to explain to you how much you use your credit card really isn't the issue. The issue is how much balance do you have on the reporting date, because that's the snapshot in time. Some people will even move balances from one card to the next based upon reporting dates. I'm not here to encourage that. What I will say that in general, Everyone says you should keep less than 20 to 30% utilization on your credit card. So again, if you have a $1,000 credit card, don't have more than $200 to $300 charged on the reporting date. I'll tell you though, and we track this closely, I would aspire to try to get that as low as 0 as possible on the reporting date. Because even with 20 to 30% utilization, your credit score will go down as compared to having a 0 balance. But the lesson here on the second row on this page is try to keep your revolving debt balances low. But what you and I just discussed behind the scenes is that technically it's as of the reporting date that the world sees your debt balances, not during the course of the month. Third one down is pay off outstanding collection accounts and other debts. We work frequently with clients that's looking for business funding, and we'll do the credit review, and they'll have, let's say, an unpaid cell phone bill for $113. And it's like, my goodness, if you would have paid that $113, which maybe you disagreed with for whatever reason, but if it was really yours, if you would have paid that, then we wouldn't have this big red derogatory on your credit report. So now we've got a $113 old bill that's standing between you and getting approved for a $100,000 business loan. Isn't that crazy? So how you go about paying off older collection accounts is important. What's not really part of this curriculum, but I will tell you that there's a term called date of last activity. And let me give you an example. Let's say I owe money and you're a debt collector. And so you're calling me and saying, Tom, need you to make a payment. What are you gonna do about this balance? Can you make at least a small payment today? Well, the date of last activity, they're seeking to reset that DOLA, that date of last activity, to be current, because that resets the statute of limitations. I'm getting deeper probably than what you need to know or want to know. But the bottom line is that when you make a payment on an old debt, or even in some cases make a verbal promise to make a payment on an old debt, it can reset that date of last activity to make it new again. Well, a new bad debt impacts your credit score more than an old bad debt, because the older that the transgression is, the less that it impacts you. So there's certain ways that we need to handle paying old debts, and we're going to guide you through that. Please listen to that, because paying old debts the wrong way will lower your credit score. It's crazy. It may not make you happy when I say that, but it really doesn't matter what makes me happy or makes you happy. We've just got to be straight shooters with each other. Paying old debts down or off in some cases can reduce your credit score, not increase, because of date of last activity. So we've got a model that'll avoid that. So be cautious. Next down is avoid negative events that could result in public records. In some cases, and I'm not an attorney and not going to give any legal opinions, but sometimes bankruptcy is that reset button that people need. And again, I'm not advocating for it, but life can happen. So I don't necessarily agree with how this is written, avoid negative events. Sometimes bankruptcy is a prudent decision, and you should visit with an attorney about that. People will say, well, once you file bankruptcy, now your world's upside down. You don't have access to capital, and that's just not always true. Other people will say, well, once you have a bankruptcy, it has to stay on your credit report for so long, and that's technically not true either. We've seen bankruptcies come off credit reports quickly. So, but in general, sure, avoid bad things. Do good things with your credit, avoid bad things. The next one down is talking about, if you go looking for a home or a car, try to consolidate the period of time, typically less than 45 days or even less than 30 days, because if you start stringing that out over months and months, then those inquiries build, and they're calculated differently. maintain a good mix of credit accounts. And so that's absolutely true on the personal credit side, is having a good healthy mix of credit really strengthens your credit profile. And then lastly, credit age matters. And so we've seen people that'll go pay people for what they call a credit sweep, and they'll take all the negative items off, often everything off the credit report, and it's insanity. So keep in mind, there's a difference between optimizing credit and positioning yourself for funding, especially for business funding. It typically is not a smart thing to do to go pay someone to take all the negative or take all the items off your credit report and have a clean slate. Because unless you're 18 or 19 or 20, it doesn't add up, right? So now a lender is looking at your application, and now you're a 30-year-old, you're a 40-year-old, you're a 50-year-old, or whatever age you are, if it's not 18 to 20, and say, well, what the heck happened? Have you been living under a rock? How is it that you have no credit history? It's called a thin file. Well, we all have a thin file the day we turn 18, but normally it becomes less thin as life goes along. So we really need to be conscientious and thoughtful before we use some of these credit cleanup strategies. Now, what this slide is just simply saying is, if you have that old Sears card, don't necessarily close it even though you're not using it, because it might be one of your older accounts, and by getting rid of it, it could shorten your average credit history. And age matters in terms of how long you've been managing credit. Alrighty, when personal credit history is important to your business, so we're following the arrow from the bottom left as it swooshes up to the top right. So when we establish a new business, personal credit is going to matter a lot, because your business credit's so new. Your business is so new, and we probably even haven't established business credit. We're going to be helping you do that, though, through this process. The second dot there is when you're personally guaranteeing or co-signing on a business loan, which is going to often happen. After I came out of graduate school, I guess it was my third position, I was recruited by a headhunter, and my family and I, we moved to Houston, Texas, and I was the CEO of a large medical group, large group of surgeons. And so we had 13 offices, medical offices, and 19 surgeons, otorhinolaryngologists, ENTs. And so this was a big business in terms of healthcare, the amount of money coming through, a lot, right? 19 surgeons generate a lot of income that was going into our business bank accounts. But even at that point, it took effort to get lenders to not require a personal guarantee. So again, different types of capital have different underwriting criteria, but please don't think that you're going to rush out, start a new business, get an EIN, build your business credit, and then you're going to stroll down to the SBA or to the bank and get a loan, and your personal credit won't matter. But there certainly are types of capital, like the Home Depot card is a simple example, that you can use strong business credit off of. The third bullet from the left is accessing financing or trade credit to grow a business and qualifying for other business opportunities. Okay, so we're moving on to section 3, business credit, which is probably what you're mostly interested in, but it was important to create a foundation of knowledge about personal credit, because so often we'll have clients that have wrong perceptions about how personal credit plays into this whole campaign. Well, what are business credit reports? They're risk assessment tools used to evaluate the risk of lending, extending trade credit, or contracting with the business. So we're going to compare personal versus business here. And as you would expect, it is very much different, because one is based upon your social security number, your personal credit went off the EIN credit, your business credit. But what you will notice is inquiries is one of the biggest differences here on this graph. When you go out and inquire a lot personally, that can impact your access to capital. So we may want to work together to remove some inquiries if you have excessive inquiries. There are certain ways that can be done in certain cases. What you'll notice on the business credit is it's really not as much about inquiries, but it's about the business setup. And we'll help you go through that. It's part of the small business certification. And we'll see some details here in some slides soon, that how you set up, like from a personal perspective, you don't have to worry about setting up your personal credit, do you? You know, assuming that there's nothing wrong, you've not been a victim of identity theft, you are who you are, and as long as that's reported, then you're fine. Different beast, different animal on the business credit side. We're gonna have to spend some time building your profile first, because it's not going to be right. It's not going to be accurate. It's not going to be optimized. So significant difference there. There are different players in business credit than personal credit. Personal credit, we said Equifax, Experian, and TransUnion. You're going to see a couple of these names again, but let's start with the top. We have Dun & Bradstreet, D&B for short, and it's one that we often hear about. I'm not here to say anything negative about anyone, but I will tell you that if you call Dun & Bradstreet or make an inquiry, they are very good, but they tend to be very aggressive salespeople. So they're going to often try to sell you packages, and you may want them and you may need them, but they're aggressive. And so sometimes the way that they'll present those packages is that you can't get your desired outcome if you don't buy one of those packages. And that's typically not the case. Through our curriculum, we're going to be able to teach you how to do those same things without having to pay that $1,000 or $2,000 fee to Dun & Bradstreet. But that's not to say that you shouldn't use their services and pay for them. So they're certainly an important business credit reporting agency, no question about that. But understand, credit is big business. It's a multi-billion-dollar business. Dun & Bradstreet is out to generate income by buying and selling data and by offering you fee for services. So not saying anything negative, very strong company. Just letting you know that once you start to interface with them, don't be surprised if they're starting to sell you packages. And sometimes you're going to be left with, oh, I better buy that package or I won't get the desired result of strong business credit profile. Then we have Equifax business and Experian business. These are separate sides of Equifax and Experian, respectively. So it's not, oh, that's the same as before. It's not. It's a different division. It operates differently than personal credit. What information do business credit reports contain? And this is important, really important, and we actually do this. Once you've completed the 4-week curriculum, then we'll dive deeper into the business credit profile. And that's something that we'll be helping you with here at our office. That is not something that the financial literacy educator in the field will be doing. The point is, the profile, that, as I just referenced a moment or two ago, is so important because it's almost always going to be inaccurate. So business credit reports will have business names, business addresses, phone numbers, your DUNS number, your industry classification, and so forth. And you might say, well, how could that be wrong? Well, typically what will happen is those 3 bureaus, Dun & Bradstreet, Equifax business, and Experian business, will often pull from public records. So when you file your LLC, your C Corp or S Corp, that creates a public record, and they'll get partial information, and they'll usually create a business credit profile off that partial information. So if we don't go in and correct add what's missing and correct some wrong assumptions that maybe have been made, then your credit profile is much weaker. And I'll just focus on one bullet and then we'll move on. The bottom left, industry classification codes. Different industries have different risk factors, right? And so typically they'll put non-classified on your profile to begin with because they don't know. In many cases, they won't pick that up from the state, Secretary of State, where you filed your paperwork to form your business. Well, when it's an unclassified or unknown industry, usually that's considered as higher risk versus low risk, and your industry may be lower risk. Well, what does risk mean? So for example, if you were to run an accounting firm, that's pretty low risk. If you had a pawn shop or a gambling or adult entertainment, and I'm not casting any judgment, those are considered higher risk. So we want to have your profile set up accurately and complete, because it makes a big difference, and it's not going to happen on its own. It doesn't happen automatically. It'll be wrong. It's all, I hate to exaggerate, but I think it's always wrong by default. It's always wrong by default, because the information that they're pulling doesn't give them enough to make it right. Regulation of business credit says many consumer lending regulations, such as the FCRA and FACTA, do not apply to business credit reporting. Business credit reporting agencies still do have procedures in place regarding getting access to reports. You are not entitled to free business credit reports. Let's say it again. You are not entitled to free business credit reports. And in fact, they often charge a lot. You could be paying over $100 in some cases for a singular business credit report. We can help you circumvent that. They also have policies on how to manage disputes and how long information stays on your report. So we're looking at, normally you'd say apples and oranges. Here they're looking at apples and other types of fruit, I guess, but just really trying to bring to the point that there's differences between personal credit scores and business credit scores. How do you check your business credit report? We're going to help you do that. That is part of this 4-week curriculum. We'll actually do that at the end as we're putting together the capital match. But regardless, the checking your business credit is important to make sure what's on there is accurate. And in the beginning, you'll probably be horrified to see how jacked up your profile is, because it's almost always really bad. And your initial scores are almost always really bad. So again, business credit's a different beast. Doing nothing will result in looking really bad. And business credit operates differently, because business credit does not require permission. Right now, you and I could pull a business credit report on any company in the United States. We could pull Walmart, Amazon, or any small business, your small business, any small business, without permission. Business credit operates differently than personal credit, where you have to have permission to do it. So with that being said, it becomes important to manage your business credit, because your competition could be pulling your business credit reports to sell against you. Your clients, your prospects could be looking at that. And certainly there are some monitoring services that are available to let you know when there are changes on your business credit profile, really no different than on the personal credit side. So as I mentioned, we'll take care of your business credit reports, pulling those and looking at those and reviewing those with you. What it's showing here on exercise 2 is we're going to go through a checklist, and we need to make sure everything's correct. And you'll see on the print screen there, is the business name correct or incorrect on the business credit report? Is the business address right? Often the business phone number is not even on there, and we need to add the business phone number. Is the website on there or not? Often that's not there, and we should add it. Has the DUNS number been added, and so forth? And so it's a checklist process to go through. Why should I establish business credit? Well, it's important for working with lenders and suppliers, customers, as I mentioned. Even insurance companies may use your business credit profile to set your premium. And a big one, they flew me out to Atlanta, Georgia, and the meeting was with minority contractors. The meeting, though, was put on by the state of Georgia, and it's not unusual that states, counties, and cities, and even the national government has contract opportunities, and they often look at your business credit worthiness as part of the approval or part of the bidding process. So if we want to get a contract with the government in most cases, and even some companies like Amazon, they may very well likely look at your business credit profile. So what's the point? It makes sense to optimize your personal, which we talked about earlier, and business credit profiles. It just makes sense to do that. It's a good thing to do. And also it increases your access to capital. We talked a little bit earlier briefly about what do you need to do to establish business credit. We do need to have the entity form. We need to have the EIN. We're going to have to get a business credit report and see what's on there. And then just like with personal credit, just because you pay your bills on time doesn't mean that you have a strong business credit profile. So for example, our office, the IIMFL office, we lease the whole top floor of an office building. And our landlord, and it's a historic building. Sometimes you'll hear cars go by on the recordings, not because the windows are open, but it's a 100-year-old building. So with that being said, our landlord does not report our on-time rental payments to Dun & Bradstreet or to Experian Business or to Equifax Business. And granted, we're a nonprofit, so it doesn't matter quite as much. But the point is, just because you pay your bills on time doesn't mean that you're building your personal nor your business credit profile. It's only if the vendors that you're working with do report. Now, that's one of the packages, and I'll just mention this because you need to know it. So Dun & Bradstreet has a package, and they suggest, oh, pay this fee, and then they'll go get trade lines, extensions, uses of credit, like my rent, that don't normally report, and they'll cause them to report. That works with mixed results. So typically, what you need to be of the mindset is that if your financial transaction is not with, we'll call them a vendor that reports, then it's not going to report. And I'll give you just an example and move on. So if we're going to go buy a car, let's say we can go buy a car two different ways with financing. We can go to a normal dealership, which will extend normal credit and probably report to our personal credit in this example, or we could go to a buy here, pay here lot. Buy here, pay here lots typically won't report. So you're still making payments in both cases. In one scenario, you're building your credit profile. In the other case, you're not. So the point is that we have to be cognizant. It's not just about paying our bills on time, but it's working with vendors that do report. Otherwise, we're probably not building our profiles, personal or business. Best practices for a strong business credit. Maintain healthy credit, pay your loans, bills, and taxes on time. Make sure your business is visible. Maintain good relationships with suppliers and vendors. The second from the bottom is really important. We want to try to separate personal and business finances, and we'll talk about that in our subsequent lessons. We need to be using for our business QuickBooks or something similar, an accounting software. So we track our business revenue, our business deposits, our business expenses, our outgoing in I'll just say QuickBooks, so we can track it properly and manage it properly. But that just goes to the point that we're on here. We need to separate personal and business and treat them separately. And you might say, well, Tom, you just said a few minutes ago that I might still have to use my personal credit to get a business loan, especially in the earlier stages of business. Well, that's separate. So it may be that a personal guarantee is necessary. What we're talking about here is try to separate the transactions. You need to have your own business bank account, which we'll talk more about in one of our subsequent lessons. We need to try to separate where we can. When you do this well, some really interesting things can happen. So for example, for our business, we went and bought a couple company cars, and those company cars are under the EIN, and those company cars do not report on personal credit. So for example, I drive a company car, it's parked out front right here, but on my credit report, I have no open automobile credit. So that lowers my reported debt. And if I wanted to go buy another car or anything else financed, my debt to income is much lower. So separating personal from business is important, and using business credit whenever possible is very valuable. So building your business credit history, what do you think? How would having a stronger business credit profile help your business? In the next 5 years, how do you think having a healthy? So we looked at it in the next year versus the next 5 years. We want to help you build that business credit profile. And that's a package that you could go out and spend $2,000, $3,000, $5,000 on. And as much as possible, we've incorporated that in to this curriculum to help you. All right, section 4, how lenders evaluate your credit worthiness. So here we have a graphic, small businesses in the center, and then around it we have consumer and business credit reporting agencies in the top right. Bottom right, companies that provide credit reporting, analytics, and scores. Bottom left, federal and state laws. Top left, lenders and businesses that use credit reports. And so we have this whole ecosystem, all these interrelated factors. That's helpful, but the next slide is even more important. This is a very important slide. Very important slide. It doesn't quite as clearly stated as I would, but these are the 5 C's, and it does mention it briefly in the bottom left. We often talk about the 3 C's of accessing capital. So, back up. We know that there's different ways to get capital to start and grow a business. We can use debt, money that we borrow that we agree to pay back. That's really what this is most relevant to. There's equity-based funding, money that we get that we don't have to pay back, but whomever is providing the funding is wanting to share the future rewards. And then the third scenario is earned income, where we have more cash coming in than expenditures, so we can invest back in. In terms of the debt-based space, we often talk about 3 C's. Here we have all 5 C's, so we're going to go through them. So we're looking at the blue boxes from the left to the right. Capacity, now I usually call that cash flow, but it's capacity technically. And so that means, do we have the ability to service the debt? Do we have the ability to pay it back? Sometimes we'll have small businesses that come to us and they'll want to borrow a whole lot of money, and there's no visible evidence that they could afford to pay it back, right? It has to make sense. Now, with that being said, we did a $1.2 million deal on a franchise, a pizza franchise in Tyler, Texas. And so in the beginning, the business didn't exist. We had to buy the franchise, lease the space, build out the space, get the equipment, hire the staff, and turn the light switch on. But we need to be able to show that our business, or at least our global income, meaning both our personal and business income, provides us the capacity or the cash flow to service the debt, to pay the bill. Second C is collateral. Different types of different sources of capital have different collateral requirements. We've done loans for helped small businesses as a technical advisor get loans. We're not a lender. I worded that poorly. We've helped clients get loans where they really didn't have much collateral. We had one lady, she pledged, and I'm not joking, 300 pairs of shoes as her collateral for a smaller business loan. So some business loans will allow you to pledge just personal assets, furniture and art and guns and jewelry. Others are a little bit more formal. One type of collateral is called a collateral assignment. it falls under what's called a key person policy. And so that's a type of collateral that some lenders prefer, some require, that if you were to die, then the life insurance policy that's owned by the business is the beneficiary. But talking about collateral, there's a collateral assignment to the lender that if the key person, in this case probably you, were to die while the loan is open, that the lender would be paid in full. So what's the point? Collateral can take different shapes. If we're going to go buy a business office building, guess what's going to be the collateral? The business office building. So if you don't pay back as agreed, they'll foreclose on the business office building. But if it's a working capital loan, usually we're using the funds in a different way where there's not much tangible collateral. So different collateral for different circumstances. That's part of what we're doing, is gathering all the data to figure out what is the right type or right source or sources of capital based upon your circumstances, and these 5 C's fit into that. The big blue box in the middle is credit history, and we've talked about that can incorporate both personal and business credit. Depending upon the source of capital, they may only look at business credit, they may only look at personal credit, or they may look at a combination of the two. Next are conditions. Conditions are kind of the wild card that could be how you're going to use the money. So for example, let's go back to the SBA $150,000 7A Express loan. If you're going to use that to buy inventory, that would probably be a more favorable condition than if you were going to use that to do a bunch of marketing, $150,000 of marketing. So the conditions can be how you're using the money, but also it can be the macro market conditions. And without a doubt, the current economic impact of the COVID pandemic has impacted the lending landscape. Is there still money being lent and invested in small businesses? Absolutely. But have the conditions changed from a year ago, for example? And that they have. And then character is about you. And one of the aspects of character, and again, it depends upon the source of capital, but they may say, well, what industry experience do you have with this? Some types of capital don't care at all, but others, and it's part of what we'll do together, is build a bio, or I don't say a resume, because a resume sounds like you're getting a job, but your bio that explains why you're qualified to run the type of business that you're looking funding for. So here are 5 boxes, the 5 C's: capacity, what I call cash flow, collateral, credit history, conditions, and character. Different sources of capital use different of these boxes and to different extent. And then there's also non-traditional data that can help predict risk. There's personal credit reporting examples, and now you can do, I think it's the Experian Boost, and have some of your other payments that's normally not reported impact your credit score. I don't want to focus on that as much as I do the next bullet, which is on the business credit reporting side. If you have good cash flow, that can open up, like one of our favorite sources of capital, which I know we'll talk about in module 4, are lines of credit. We can do up to $100,000 line of credit, which of course is good because it means you're only paying interest when you need to use it. And it can be a very early stage business, and credit doesn't matter, but it's based upon cash flow. And it's not a merchant cash advance. But the point is that there are different sources of capital that use different requirements. And here we're on the page of non-traditional credit data that could be things such as how much credit card receipts do you have coming in on a monthly basis. And so the point I was making is we have an example that different lenders have different priorities or different underwriting circumstances. And so here, see in the bottom right-hand corner, it says lender A, they're using a certain mix. and then lender B is using a different mix. And so that's part of what we're going to help you navigate through. We'll complete the 4 modules of the small business certification. We'll put together the capital match based upon your mitigating factors. All right, and so when we talk about best practices for entrepreneurs, it is important to know your credit, both your business and personal, knowing your lender, and that's part of what we're doing with the capital match, and knowing your rights. And there's a self-assessment in your participant guide that you may wish to go through. We won't take the time here together to do that. But what we have done is we made it all the way to section 5 of 5 sections. And again, I apologize, this is one of the longer lessons. You have the benefit, though, to pause and take a breather when you need. All right, so wrapping it up, section 5, credit reporting and business operations. So we have a graph here on the left-hand side, accessing credit reports, and the right-hand side, reporting to credit reporting agencies. And I'll let you read this at your own pace. But I guess the bottom line is it matters in terms of how you manage your credit. It is going to most likely impact your business operations. So we want to be proactive and engaged, and we're offering to help you build your business credit profile out. So what are some key points to remember? Personal credit histories operate different than business credit, and how they're calculated, how they're used, how they impact your business. But in all cases, as it states there in the bottom, paying your bills on time from this point going forward is probably the most important thing that you can do to optimize your credit histories, your credit profiles. And then secondly, we'll help you review your current profiles and create a plan if there's any optimization that's needed. Are there any key points to remember? Absolutely. So personal credit, business credit are important for your business. Manage them can help you improve access to capital. Lenders and others use credit information in different ways. So again, there's not simple answers. You know, if someone asks us, well, what credit score do I need to be approved for a loan or for accessing capital? That lets us know that they don't know what you and I know by having gone through this lesson, is there's not singular answers. Different sources of capital have different underwriting requirements. But we certainly do need to understand your credit history. We don't want to ignore it, even if you think it's not so good or you know it's not so good. Let's get our arms around it so we can manage it and optimize it. And the stronger your credit, it is going to increase your financing options. Not saying that all sources of capital are credit dependent, because they're not, but it will increase your financing options. So as we summarize, you might think about what questions you have. You can write those down, and then when you visit with us as we review your personal and business credit profiles, we will be happy to address those questions. Hopefully you've learned a lot. The pre and the post test that's there in the participant guide is a way for you to better judge that. But hopefully this has been useful and practical and a good use of your time. And there is the evaluation also in the participant guide. I will add that we're looking for more financial literacy educators. So if you might want to help us teach this as a live Zoom instead of an on-demand, if you might be interested in teaching this in person, again, through churches, chambers, co-working spaces, let us know, because we are looking for more financial literacy educators to teach this course and this curriculum. Okay, so wrapping it up. So this is the last slide. So if you've not done so, please go ahead and fill out the evaluation form and the pre and post test that's there in your participant guide, and you'll be giving those to your financial literacy educator when they're in touch with you. And we are going to do a soft credit pull, with your permission, obviously, but we're going to do a soft credit pull so we can take a look at the personal credit profile. So with the email that you received with access to this module, to this lesson, there was also a link to go ahead and click on so we can do the soft credit pull. Doesn't cost you anything, doesn't impact your score, but we need that to do our part to help you understand where you're at. And then once we get through the 4 modules, we're going to take a deep dive in and help you on the business credit side as well. The personal financial statement is one of the key activities that we need you to do between now and before you do the next lesson, lesson 3. We should have assigned or should be assigning a financial literacy educator to help you with this. However, again, the email that you received that provided you access to this module also had a link and instructions on the personal financial statement. So you can go ahead and start to work on it on your own. And that's fine if you're comfortable working on your own, but we still want to review it with you. And I'll make this commitment. If your financial literacy educator is not available, I'll personally review this with you, because this is an important bridge over to the 3rd topic. And the PFS, the personal financial statement, is an important instrument as we prepare to go to funding. This is a PFS specifically from the SBA. This is not an application to apply for an SBA loan. This doesn't even mean that we think that you'll necessarily, that will be your best type of capital. It may or may not be, but we need a template to use, and this is a good one to use. So that's why we use it. So again, thank you for your time. I'm sorry that this was a longer course. We needed to reestablish or establish a good foundation on personal credit and then start to build in the importance of business credit. I think we've done so. Now we need to apply it. None of this is going to change your access to capital just by having increased knowledge. It's good, but we need to apply it, and that's what's going to happen next. So thanks, everyone, and we'll talk to you again here soon. We'll be on our 3rd module next, which is financial management. Talk to you soon. Thank you. Bye-bye.